Hey guys, in this video, we are going over 5 top dividend stocks that pay up to 12% per year. I've done tons and tons of research, and this is my list of 5 of the best high dividend stocks that you can buy today. Make sure to watch all the way through to get my full analysis on each of these companies, and I'll show you guys how they could potentially make you a lot of consistent returns. So what is a dividend stock? Well, simply put, it's a stock that pays you a relatively high percentage of your investment per year. This money comes from the stock's earnings, and it's a reward that the companies pay for these investors to put their money in that company. You can make money through stocks when the value of the stock grows, and also by holding stocks that pay out a relatively high dividend. What results is a pretty passive form of investing that many people have had lots of success with. Now, in choosing a high dividend stock, it's smart to look at solid companies that have paid out dividends for a long time and that have strong financials. A lot of the companies on this list are on the riskier side, but that risk is something you always have to look at when you are looking at companies paying up to 12% in dividends. So with that, let's get started. The first company on my list is ALTRIA Group, stock ticker MO. This is one of the largest producers and marketers of tobacco and cigarette products in the world. Yes, tobacco, probably not the most ethical thing to invest in, but it is hard to deny their super high dividend yields. So right now, ALTRIA Group is trading at $38.72 with a 52-week low of $30.95 and a 52-week high of $52.45. This means that its current price is about 26% down from its all-time highs. We can see that it started dropping in late January of 2020 and then hit its low in late March, and since then it's recovered about 25%. They currently have a market cap of $71.92 billion and they don't have a PE ratio right now because their earnings are negative. Right now, ALTRIA Group has a dividend yield of 8.55% with a payout ratio of 78.78%. Its 5-year growth rate is 10.4% and it's had dividend growth for the last 50 years. We can see that its dividend yield has been going up a lot in the recent months. Its 4-year average yield is 5.19%. Now getting more into the financials, its current price to book ratio is 11.98 with a profit margin of negative 4.21%. Its return on equity is negative 8.36% and its current ratio is 0.71. Now let's take a look at what the analysts say on a scale of 1 to 5, 1 being a strong buy and 5 being a strong sell. ALTRIA Group is a 2.1 on the scale, meaning that it is a buy. The current average price target is $47.93, which is 24% higher than its current price. Tobacco companies were definitely worried about vape companies taking over the market, but even with all the negative press about vapes and its health consequences in the recent years, they are still taking a beating in their price. I definitely think that this could be a good dividend stock. There's definitely risks with the regulatory and tax pressures, but one good sign is its price target of $47.93, which we previously covered, being almost 25% higher than its current price, which means that there's a lot of potential upside. Analysts on average do think that the stock is undervalued right now. It pays a consistent dividend and it's actually quite a diversified company. They have interest in many different types of brands and products. Its negative earnings are definitely a little bit scary, but we'll see what happens in the coming months and hopefully they can turn that around. Next up on my list is AT&T, stock ticker T. This is a telecommunications company and you've heard of them. You've probably even had your cell phone plan with them at some point in your life. This company, you guys, is the safest one on this list. Currently, AT&T is trading at $30.34 with a 52-week low of $26.08 and a 52-week high of $39.70. This means it's about 25% down from its highs. We can see that there was a relatively big drop in March, although not as bad as many other companies. And since then, it's recovered quite a bit, but only by around 13%. Its current market cap is $216 billion. It has a PE ratio of 15.4 and a PEG ratio of 7.46. Now, taking a look at their dividends, we can see that their current dividend yield is 6.89% and their payout ratio is 64.8%, which is just all right. This means that they are paying 64.8% of their earnings as dividends. Its 5-year growth rate is 2.09% and it's experienced dividend growth for the last 35 years. Let's take a look at its price to book ratio, which is currently 1.33, and its profit margin is a relatively low 8.05%, and its return on equity is 7.99%, which is also quite low. Looking at its financials, we can see that its current ratio is 0.76, and this does mean that it has more current liabilities than current assets. Analysts currently rate this as a 2.7, meaning that it's a hold, and its current average price target is $33.72, which is 11% higher than its current price. Investors are currently quite scared about AT&T because they have almost $150 billion in debt. This is due to their acquisition of Time Warner in 2018 and also investments into starting up its streaming business with HBO Max. One reason why I think AT&T could be a good buy right now is because they still have a lot of cash. And I think that being about 25% under its 52-week high is quite under what it should be at. It has a strong dividend of almost 7%, and they've paid out growing dividends for 35 years. Its next earnings is on July 23rd, and they're expected to report an earnings per share of 80 cents. This would be about 10% down from the same quarter last year. AT&T is also a 5G stock with its rollout of its 5G network over the next few years. Though this definitely won't be cheap, it's going to increase the speed of data by a lot, and this in turn is going to increase the amount of data used by its customers. This will for sure bring in a lot more profits in that segment. Overall, AT&T is not a super high growth company, but it is a company with a very solid dividend. I do believe that it is the safest one on this list, so if you're looking for something that's a bit more safe, then definitely check out AT&T. Okay, number 3 on my list is Prudential Financial, stock ticker PRU. This is a 140-year-old investment and insurance company. They provide life insurance and investment management services throughout the world. Currently, Prudential is trading at $61.64 with a 52-week low of $38.62 and a 52-week high of $103.56. So obviously huge swings. It's down almost 40% from its 52-week high. We can see that there was a huge collapse in March, and since then it's slowly been growing, but had a pretty big drop recently. Its market cap is $24.352 billion, and it has a PE ratio of 8.48. Its current PEG ratio though is 1.44. Now, looking at the dividend, right now their dividend yield is 7.29%. Their payout ratio is just 50.08%, which is pretty good, and its 5-year growth rate is 13.01%. This stock has seen dividend growth for the last 11 years. Now, its price to book ratio is a super low 0.49, meaning it's trading for about half of its book value. Their profit margins are 4.73% with a return on equity of 5.2%, which is very low. Looking at its financials, its current ratio is 0.8. Now, analysts say that this is a 2.9, meaning that it would be a hold. And its current price target is $63.75. This means that its current value is just a few percent under its price target. Now, in my opinion, Prudential was a company that did well before the pandemic, and I do think that it will recover to where it was before. Currently, its price to book ratio is extremely low at 0.49, and that's a really big sign that a company is currently undervalued. Its dividend yield of over 7% is very strong, and it's also good to know that it's only paying out about 50% of its earnings on this dividend. The total revenues from this past year are down 2% from the year before, but they raised their dividend by 10% on their last payment on March 12th. Its forecasted earnings per share with this pandemic is sitting around $9, which is about 25% under what analysts expected in March. It has a low PE ratio as well as a low valuation, and combined with a pretty attractive dividend makes this a good opportunity for a lot of people. Okay, next up on my list is EXXON, stock ticker XOM. This is an oil and gas corporation that's based in Texas. Currently, EXXON is trading at $46.87 with a 52-week low of $30.11 and a 52-week high of $77.93. They started falling in January, hitting a low in late March, and since then it's rebounded quite strong, although still not even close to its 52-week high. Its market cap is $198.2 billion, and its PE ratio is 17.58. Now, looking at the dividends, we can see that their current dividend yield is 7.54%. Their payout ratio is 130.58%, which means that they're paying more than they're actually earning in terms of dividends. They have a 5-year growth rate of 4.9%, and they've had dividend growth for the last 38 years. Their price to book ratio right now is 1.24, and they have a profit margin of 4.57%. Their return on equity is 6%, which is quite low, and their current ratio is 0.78. You can see that there's a trend where a lot of these companies have a current ratio of under 1. The reason why a lot of these companies have super high dividends right now is because they're struggling. And when companies are struggling, that means that their share price is going down and the dividend yield is thereby going up. So analysts rate this as a 3.1, meaning that it's a hold, and its average price target is $47.63, which is just 0.5% above its current price. For those that think oil won't be fully phased out anytime soon, this could definitely be a good opportunity. Yes, with electric and other energy sources rising in demand, I do think that oil will still be here in the foreseeable future. Exxon is a huge company, and they've been paying out their dividend for over 100 years. Yes, it's definitely quite volatile, but its long-term payouts have been very attractive, and I do think we should expect some growth increases in line with the price of oil going back up. So yes, this is a risky stock right now. It's very volatile and its current payout ratio is 130%. This means that they have to find other sources to actually cover this dividend beyond their earnings. The problem with a dividend like this is that they are so focused on always increasing this dividend. This means that they aren't taking earnings and reinvesting it into the growth of the company. EXXON has always been a very stable and good dividend stock that many people really like. So right now with its prices very low, it could be a good time to actually get in right now. All right, last on my list is MONROE Capital. MRCC. This is a private equity firm with investments in tech, healthcare, media, and retail. Right now, MONROE Capital is trading at $7.41 with a 52-week low of $3.56 and a 52-week high of $12.10. This means it's down about 40% from its 52-week high. If we zoom out on the chart, we can see that there was a huge, gigantic drop in March, and since then, it's just about doubled. Their current market cap is $152.7 million, not billion, so the market cap is very small for this company, and they don't have a PE ratio because they do have negative earnings. The dividend of MONROE Capital is the highest on this list at 12.2%. Their current payout ratio is 85.32%, which is nearing 100%, so that is a little bit risky. Its 5-year growth rate is 0.58%, and yeah, they just cut their dividend a bit, so they don't have any dividend growth right now. Their current price to book ratio is 0.82, which is cool to see under 1, and its profit margin is negative 37.41%. Their return on equity is also negative at negative 10.8%. However, they do have a pretty strong current ratio of 4.32. Now, analysts say that the stock is a 2.1, which means that it is a buy. And the current price target is $8.25, which is 15% above its current price. So last quarter's dividend payout was 35 cents per share, but the earnings for this quarter aren't able to pay that out. Therefore, the dividend that's due on June 12th is 25 cents per share. This is still great, and it results in a 12.2% dividend yield. We should expect to see further decreases in their dividend payouts, sort of in line with their earnings. So it is very possible that this dividend yield decreases for the next quarter. Yes, it is concerning that they do have negative earnings right now, and that is why the risk with this stock is quite high. One of the companies that they are invested in, Rockdale Blackhawk, is currently in bankruptcy, but they should be receiving their judgment in that bankruptcy case in the next few months. This will boost their investment income and also help with their finances. Overall, MRCC, it's a company with an extremely high current dividend yield. But the question is, how much lower could this dividend yield get if the revenues continue to keep hurting? With any high dividend yield stock, this probably means that there is some risk, so you guys have to be aware of those risks. If you guys haven't signed up for WeBull yet, make sure to do that and claim your 2 free stocks worth up to $1,650. All you have to do is open up an account and deposit $100 or more, and you will get those 2 free stocks. I will also get one as well, so using the link down below in the description will help support my channel. So in conclusion, you guys, don't buy stock just for its dividend. Although for many of the companies on this list, the strongest attraction right now is its high dividend yield. I have to reiterate, a lot of these stocks are very risky right now. Some of these companies might pause or lower their dividends due to their low or negative earnings. However, it does seem that the economy is starting to pick back up, but only time will tell. Before you guys invest, make sure to do your own due diligence, make sure to research these companies on your own, and just use this video as a starting guide. Happy trading, you guys, and thank you so much for watching. If you like this video, make sure to hit that like button and also subscribe to my channel if you want to see more videos just like this. I make a ton of content about investing, personal finance, and entrepreneurship. So I'd love to see you guys around. Anyways, that's it for today. Thank you so much, and I'll see you guys in the next video. Peace.